Coming up on the program, OECD forecasts global economy to suffer worst peacetime slump in 100 years. Libya's top oil field shut after government closed it yet again. And Cote d'Ivoire to reduce fees paid by domestic cocoa exporters. Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi Iwago. First, the markets. And here in Nigeria, the all-share index was unchanged at noon. In South Africa, the JSE index was down 0.75%. The market in Egypt was also down 1%. Kenya closed in the red on Tuesday. And major Gulf stock markets were mixed at intraday as banking shares weighed on the Saudi index, while property shares supported the Dubai index. The benchmark index of Saudi Arabia, which has reported the highest number of new coronavirus infections in the 6 countries of the Gulf Cooperation Council, slipped 0.27%. In Qatar, the index eased 0.78%, with Qatar National Bank, the Gulf's largest lender, losing 0.8%, and Qatar Fuel falling 1.2%. In Dubai, the index rose 0.02%, with Emma Properties rising 2.5%, and Emirates Integrated Telecommunications up 1.6%. The Abu Dhabi index was down 0.02%. And investors in Europe have been digesting the latest economic forecast by the Organization for Economic Cooperation and Development. The OECD says the coronavirus pandemic is on track to cause the worst recession outside of wartime in 100 years. Well, let's cross over now to Conrad for more insight. Hello, Conrad. Good afternoon. Good to see you again.
Good to see you, Timmy. Hello from Frankfurt to everyone watching in Nigeria, too.
You're welcome. Well, it's a shaky day on the European stock markets. The OECD has updated the outlook for its 37 member countries. What's the outlook like, particularly for the countries in Europe?
Well, the interesting thing is that the OECD actually has not only one forecast this time, it has 2 scenarios. One scenario in which the virus is brought under control, and the other scenario reckons with the possibility that a second outbreak of the coronavirus hits the world before the end of this year. In scenario 1, the total contraction of economies of the 37 OECD countries is expected to be 6%. If scenario 2 happens, then the contraction will be 7.6%. Among the 37 member countries, Spain is the economy which will likely to be the hardest hit this year, followed by France and Italy. Germany is in the middle of the field, and worldwide, South Korea is expected to be the economy least hit, with a maximum contraction of the economy there of 3%. Of course, for people on the financial markets, all this is a painful reminder that a quick and fast recovery of the economy is not really to be expected. The OECD says in both scenarios, the recovery after initial rapid resumption of activity will take a long time to bring output back to pre-pandemic levels, and the crisis will leave long-lasting scars.
And in the U.S., the Federal Reserve's monetary policy markets will conclude a 2-day meeting today. Anything bold to expect from them? What's the expectation on the market?
Well, the most important thing that Jerome Powell, the Fed chief, will have to say today, according to what's expected on the markets, is the economic outlook. These are the first economic projections by the Federal Reserve since the coronavirus pandemic caused or set off a recession in the United States in February. In terms of monetary policy announcement, no bold things are expected on the markets. Of course, the Fed is already doing a lot. It's doing much more than the European Central Bank. Since the middle of March, the Fed's balance sheet increased from $4.2 billion US to $7.1 billion. That's a sign how large the asset purchases by the Federal Reserve are, how much money the Federal Reserve has been pumping into the economy. Also, at the beginning of this week, the Fed announced that it will ease the conditions for a loan scheme that small and medium-sized businesses in the United States can access. So a lot has been put in place in terms of what monetary policies can do. The Fed is likely to first want to wait and see how they work before they consider new, bold monetary policy moves.
And a new star is on the rise with Nikola, a truck maker based in the U.S. that hasn't sold a single vehicle yet. But the valuation of the company is already higher than the one of Fiat Chrysler. What's the reason for investors' optimism?
Well, reason number one is called hydrogen, and reason number two is called Tesla. The success of Tesla, the electric car maker, has shown that companies can get high valuations without selling a lot of cars and without making a lot of profits. By the way, the origins of the names of the two companies, Nikola and Tesla, are the same. They both refer to Nikola Tesla, a scientist born in the 19th century who did a lot of research about electricity. But apart from this connection to Nikola Tesla, the two companies, Nikola Motors and Tesla Motors, have no connection. Now, Nikola, the car maker, is currently developing a truck that is supposed to be driven by batteries, fueled by hydrogen, by fuel cells. The car makers say it will be able to deliver or to start serial production here in Germany, by the way, as early as next year. It's an American company based in Arizona, but it has connections to Germany. It has a production facility here. It's being backed by Bosch, which is a large German industrial group, and it's also backed, you mentioned Fiat Chrysler, by the founding family of Fiat, the Agnelli family from Italy. Since Nikola came to the stock market last week on the Nasdaq, the share price of Nikola has doubled. Now, a lot of enthusiasm for this hydrogen technology and in particular for this truck maker.
All right, Conrad, let's keep our eyes on Feds. Jerome Powell will be briefing 2:30 p.m. Eastern Time. So let's see and wait and see if he's going to say anything different. Thank you and enjoy the rest of the day. Still on the OECD report, the organization says the UK economy is likely to suffer the worst COVID-19 damage. Let's see how that is playing out in the UK with Juliana. Hello, Juliana. Good afternoon. So, how are the markets digesting the dismal OECD forecasts?
Good afternoon, Chimese. Well, the FTSE did open in the red at early trading, and at intraday it's shed even more points. As you said, we had this pretty dismal reading or forecast from the OECD. The International Governmental Organisation predicts that Britain will be the worst country to suffer from the COVID-19 pandemic. It predicts that this year UK GDP could fall by as much as 11.5%. It's worth noting that it was closely followed by France, Spain and Italy, with between a drop of 11.3 to 11.4%, which is pretty terrifying and very worrying. There are suggestions that it could be as much as 14% of a drop in GDP, and that's if this report of a second wave of infections does indeed take place. And that there's a lot of people talking about a second wave that will be hitting British shores and across the world very, very soon. In fact, before autumn. So I'm sure the British government will be pretty nervous about that. I suppose one of the reasons why Britain will be the worst sufferer of COVID-19 is because the world is locked down, and British GDP does heavily rely upon the service industry. 80% of our GDP does come from services and hospitality. We know restaurants are shut. The British government, led by Prime Minister Boris Johnson, has been trying to roll out a phase of opening up the economy, but no signs of when restaurants will be open soon. There are some suggestions that this could be as early as the 14th of July, some saying it will be much further than that. And then, of course, to topple that, we've got this new 14-day quarantine. So even though some airlines are trying to open up borders, if you come into the UK at the moment, you have to stay locked down. And this is causing lots of concern, not just for the airlines, but for the hospitality industry, as this has a knock-on effect. So, yes, pretty bad, and the markets have read that data. The all-share at intraday is down 0.43%. The FTSE 100 is down by 0.21%, and the FTSE 250 down by 0.64%. In currencies, the pound is up on the dollar by 0.34%, slightly up on the euro by 0.03%, and down on the Japanese yen at intraday by 0.06%.
And do the markets also have an eye on the Fed's decisions today?
Yes and no. Of course, it's taking place much later in the day. I think the OECD reading definitely hit the markets pretty hard, but there's no doubt about it. When Jerome Powell talks, the world listens, because America is such a vital economy. It is the world's largest economy. And as Conrad was just saying in Frankfurt, this is the first time we're actually going to get an economic forecast by the US Federal Reserve since the pandemic. So I think the last time they did this was in December 2019. Now, Powell has said on the record that, you know, forecasts are just forecasts. So, you know, especially at the moment with how tipsy-turvy the world is, it's very difficult to predict. But he does face an interesting scenario. Of course, America is the worst affected country for COVID-19. They've had over 110,000 deaths. And there is a second wave. There are so many peaks coming up in certain towns and states that perhaps Donald Trump could have been too early in trying to urge governors to reopen the economy. But with an election coming up in November, Donald Trump would like this election to be a referendum on the economy, because up until the pandemic, he had been doing pretty well on that. So he'll have that to faction in, as well as the US unemployment figures, which, surprising to most, they have been picking up. They have been improving. But then again, they still have the ongoing spat with China and the war of trade, which is ongoing. So yes, in London, everybody will be listening in to what Jerome Powell has to say, but no economic measures on interest rates, I think, are to be expected.
And it's interesting to know that the Bank of England's chief economist, Andy Hilding, has been reappointed for another 3-year term on the Rating-Setting Monetary Policy Committee. He first joined the MPC in June 2014. What makes him outstanding?
Well, he's brilliant, Chimeze. You know, he is Britain's foremost chief economist, and he's definitely heralded as being one of the best economists, the economic brains that we have, not just on the continent, but perhaps in the world. There are no surprises that he was reinstated because he was tipped to take over Mark Carney, very, very close in tipping the new successor, Andrew Bailey, to the post. But some would say that because of his background, he would have been more favoured by a Labour government than a Tory government. Most central bank governors are pretty behind the scenes. They tend to be people that take a kind of a muted approach to how they respond to policy and financial policy on camera. Haldane is not like that. Ever since the fallout of the pandemic, he has been very vocal in giving his opinions on how the Bank of England should try and support the British government, even when many people knew that the current governor, Andrew Bailey, was completely against negative interest rates. He was one of the first of the MPC to start talking about them and saying that, you know, that's potentially something the Bank of England will have to take into account. He also grew up in the 80s at a time when unemployment was at record high levels in the UK, in the north of England, at about 11 million. And now that's what some people have said is spurred him to become an economist, spurred him to be a little bit more to the left, to allow trade unions to have more of a say in companies. And I suppose that's one of the reasons why he's considered as quite a radical monetary policy committee member. But yes, to the city and to most economists around the world, there's no surprise that he got this reinstatement.
Well, I wish him best of luck. Thank you very much, Juliana. Enjoy the rest of the day. Well, we'll take a quick break, and when we come back, Libya's biggest oil field shut again. Details in a moment. Libya's biggest oil field has been shut after gunmen forced production to stop twice in one day, fresh proof of the challenges the conflict-ravaged North African nation faces in reviving its energy industry after a 5-month halt. The southwestern field of Sharara stopped pumping when armed men entered the site on Monday and told employees to end activities. Though operations were allowed to resume, the group soon halted output again. The National Oil Corporation has declared force majeure on loadings from the field. The saga at Sharara put Libya's unpredictability as an oil supply on full display. The on-again, off-again status threatens a nascent revival of the exports from the country, which has produced little crude since January due to a civil war. And leading cement manufacturer Bua Cement PLC has announced a 25.1% increase in revenue of 54 billion naira in its first quarter financial results as at March 31st, 2020. The industrial giant, which is Nigeria's third largest listed company by market capitalization, also recorded a 15.7% increase in its profit before tax, which grew to 20.1 billion naira, while its profit after tax surged by 26.2% to 19.8 billion naira within the period, backed by consolidating key markets, increased capacity, and growing market acceptance of Bua products. At the same time, the cement leader recorded 16.7% rise in earnings before interest, taxes, depreciation, and amortization, which stands at 24.6 billion naira. Its operating profit jumped by 15.6% to 21 billion naira. Earnings per share grew by 26.1% to 58 kobo, while cement volume dispatched also increased by 20%. The company's managing director and CEO, Mr. Yusuf Binji, says the excellent first quarter financial results, which comes amid the COVID-19 outbreak, is yet another milestone of the cement company since its listing on the Nigerian Stock Exchange. And Ivory Coast Coffee and Cocoa Council is introducing reforms aimed at boosting domestic exports, including reducing fees they pay when acquiring beans. The new measures also limit stockpiles of beans by multinational traders that domestic exporters say drive up prices and prevent them from fulfilling export contracts. The new reforms are recommended in an audit ordered by the CCC. The audit found domestic exporters have been paying certain fees to the CCC, including for storage and security, both when purchasing excess beans from multinationals and when exporting. The double payment, which added 40.6 CFA francs per kilo to export costs, was due to an error in the CCC system for calculating fees. The audit also recommended that the CCC reduce the amount of beans that exporters can stockpile to 2% more than the volumes they have export contracts for, rather than the current 10%. All right, let's take a peep in South Africa as the country eases out of a stringent initial lockdown. Critics suggest that economic devastation and loss of life from neglected diseases will far outstrip the repercussions of the coronavirus pandemic. Now, the South African Reserve Bank published its first financial stability review for 2020 at the end of May, and the news wasn't good. The review forecast that the country's gross domestic product will contract by 7% in 2020. The National Treasury's projections suggest a contraction of between 5.4% and 16.1%. Now, that's the mild end of which would equate to South Africa's worst economic performance since the Great Depression of the 1930s. And then the World Bank, in its recent report, expects South African economy to contract by 7.1% this year, the deepest contraction in a century and 8% weaker than previously forecast. Now, joining me is an economic, energy, and political analyst in South Africa, Sebo Kadima. Thank you very much, Mr. Kadima, for joining us on the program.
Well, greetings to you and greetings to the viewers of Channels TV.
Well, President Ramaphosa says he is worried as South Africa COVID-19 cases rise. But for you, as an indigene and an economic watcher, what worries you the most?
Well, what worries me the most, and I think with many others, is the economic devastation that has resulted from the extended lockdown period. And when one looks at the impact to date, the knock-on effect on the economy, it should be in the region of 9.6% if we take into account from the inception of the lockdown to date. Now, the question that is still outstanding that needs to be answered is for how much longer will the lockdown provisions and the containment measures continue, because that will probably maybe bring us to the figure that has been mentioned by National Treasury of even 16%. So that is even more worrying, that National Treasury, it would appear as government, they are projecting that the lockdown period will go beyond September. So certainly, if the lockdown, if we stay at level 3 and maybe move between level 3 and level 2, it would mean that by September then we would have a 16% contraction from the 9.6% that I have computed today.
Now, in other words, the projections we have seen so far, yes, the World Bank a few days ago came out with its own projections of 7.1%. In other words, you're saying that these projections are quite optimistic. Now, a lot of people, yes, have criticized President Ramaphosa, most of his economic policies. In what areas would you say the president has got it wrong, especially in handling this COVID-19?
Look, I would say that I think what should have happened is lockdown measures by themselves are not sufficient. The government has been rather slow in being able to come up with therapeutic protocols that could ensure that not only are they preventative in nature, but we also treat those that are infected. And I think that is the biggest weakness that we have seen here. And also in terms of the development of a vaccine, not much appears to have been done, because the government has not yet reported to us, the public, as to what is the progress in that regard. So I think in terms of the therapeutic protocols, the government has been slow, but also they appear to have neglected the negative impact of high unemployment. We must now realize that well over 3 million South Africans have been expected to live on under $1 a day. And that certainly, I think it spells a very difficult time going forward. If the state does not have the capacity to increase the social security net, as we have seen now with the relief funding, that it's
Well, we'll sincerely apologize. Losing Mr. Kadima there, talking about some of the inefficiencies in South Africa and the way the government has been handling the issues of COVID-19. Well, in Egypt, the annual urban consumer price inflation rate sloped to 4.7% in May from 5.9% in April. The May inflation rate dropped on the back of a 0.3% decline year-on-year in food and beverage costs, reflecting a drop in demand during the Muslim holy month of Ramadan, when it normally surges. Month-on-month, urban inflation registered 0%. The North African country of 100 million people is facing tough economic repercussions from the spread of the new coronavirus, which essentially shut down its vital tourism sector from mid-March. And that's it on the program. Thank you for watching. I'm Chimeze Obi Iwagu.